these companies are still alive, they need to be earning money from somewhere else. I know where they're earning. For example, I happen to know a Robin Hood earns their money. Hey, any money in your account that you're not using stays. They do pay you some interest, but it's what? Currently, not Robin Hood pays at 6.45. Okay. Oh, Fed funds rate is 3.75. But they make a spread out of that. Starting with Fed funds rates that early, some investors actually buy stocks and bonds. Buy 100 shares, $100 of stocks, $50 is mine, $50 I borrow from Robinhood. Robinhood charges me bonds 6.25%, even to their best customers. So they make a spread out of that. Plus, they see all the order flow from their own client. Which gives them an upper hand in market making and things like options. Like Robinhood makes most of its money from option trading. They're not necessarily taking directions. They play bid and awful inside. A lot of option traders, amateur option traders, they think they get market orders, which means they need to spread. So some people sell at the market price, which means they sell at the bid price. Some people buy at the market price, they buy at the ask price. You find both of those guys, you make money. Even if you're not, there are financial techniques that you can use as if that's the case. They make money off of that. It's a very different kind of market. So that part is easy. It's not clear how long you should go to the back, how far you should go back. Even with other statistical models as well, my basic problem is you are using the past instead of, because technically MRP is the expected return that you're going to get to the market portfolio minus the risk free. Expected is about the future, not about the past. If the future is going to look a lot like the past, there is no problem using statistical models to estimate what's going to happen in the future. If you're estimating the crop yield based on different weather patterns, that's a good idea, right? Because overall, especially in a few year averages, weather patterns are pretty much the same. There's recently a little bit of a trend because of the melting of the glaciers and stuff, but even that is kind of predictable. But in stock market, that's not necessarily the case. So we need forward-looking measures. One of those is the extension of earnings yield to the market portfolio. For example, S&P now about, we did look at it, but let me remind myself. 3.25. I'm just rounding things up. And with an expected growth rate of
5% for earnings. Excuse me, and RM of 8.25. If RF is now 4%, then market risk premium is going to be 4.25. Nice thing about this is it is forward looking. Another alternative is to use a rule of thumb. When you use earnings yields, earnings do not change that fast. Because companies have incentives to keep announced earnings somewhat stable. Remember, you can and within you announce them higher than they should be, you're effectively stealing performance from the future. If you announce them lower than they should be, you're postponing performance to the future. And that's kind of a rough trend in the market. When the stock market is doing well, companies tend to massage their earnings or manage their earnings on the higher side. So when the market is doing well, earnings yield is much higher. When the market is not doing that well, earnings yield is low. Not necessarily because of the price, but the solution to this is kind of twofold. One, use an alternative indicator of risk appetite and kind of an adjustment. One of these adjustments is to average the option adjusted spread for single B and double B bonds and add a constant spread. You can determine what that constant, you can not determine. You know, look at past data, what sort of constant spread that's the ones. For example, I use 2% addition. Currently, OAS for single B let's see where I go back to Fred. $3.15. $82. Ideally, I know there's one that combines all the B and double B, but I'm going to use just this one. Hence, I would use about 4.5% for MRP. As you can see, this number is not that far away from what I got from the earnings deal. Alternative to using earnings yield for S&P 500. Remember, earnings yield is 1 over forward P, right? Is to use a more stable version of the forward P for S&P 500. Or earnings yield.